Now there's some dynamics that's making it particularly sharp, but let's look at just a quick breakdown of asset ownership by income tier. So as we look at this chart, you can see that the top 10%, so these are the folks that are in the green here, the top 10% of American households own approximately 67% of all stock market wealth. The bottom 50%, collectively own less than 1% of stocks. Again, I'm going to say that one more time. The top 10%, these are the folks that make $150,000 or more in income, own 67% of the stocks, 45% of the real estate. They have 78% of the business equity, and then 50% of the retirement assets. The top 10%. The upper mid, so that's 60,000 to 150,000, they own 30% of the stocks. That's a shocker, right? That's a shocker. Because when the stock market goes up 25% in a year, which it did in 2023, guess who benefits? Not the people who don't own any of it. The real estate, it tells a similar story. Home ownership rates among households earning under $50,000 per year have actually declined over the past decade, even as home values have more than doubled in many markets. Renters are paying more, landlords and homeowners are building more equity, and the gap widens. So we layer in what's happening in the economy right now. We have elevated interest rates, and our current president is not happy about that. The Federal Reserve, of course, it actually aggressively raised rates from 2022 to 2024 to help try to fight inflation. But what does that do? It makes mortgages more expensive. It makes car loans more expensive. It makes carrying a credit card debt more expensive. So these are burdens that are disproportionately hitting the bottom half of the income distribution. At the same time, those high interest rates are generating income for those who have savings, who have accounts in which they're making money, money market funds, treasuries, and bonds. So if you have a $500,000 investment portfolio, you are earning 5% on safe cash equivalents. That's $25,000 a year in interest without taking any risk. That's $25,000 a year that you are able to utilize in areas that could better off your life or even furthermore investments. And so if you have no savings, those rates mean nothing to you except higher bills. And then there's this tariff environment where we've seen significant tariff increase on imported goods. The evidence is pretty clear. Consumer prices go up and lower income households spend a higher percentage of their income on these types of goods. So if it's electronics, if it's what you got in the house on those household items, clothing, those are the most affected. The upper bracket, they feel it, but it's a rounding error on their balance sheet. And then you add artificial intelligence and automation into the mix. Come on now. That's more long-term structural that is going to really a force that's going to displace a significant number of middle skill jobs that's going to feel like you're in middle school over the next decade. So the people whose jobs who are more at risk in the middle of this income distribution are those that are in the middle class and the lower class. Meanwhile, those who own technology companies and AI infrastructure are poised to see their wealth expand dramatically. So again, unfortunately, those that are making under $30,000, you represent that, less than 1% you own in stocks. 37% are in a position of home ownership. And then when you think about business equity and retirement assets, it's fractional. You get into that 30,000 to 60,000, and this represents 2.5% of stocks, about 54% of home ownership, a little bit more business equity, 4% of retirement assets. But the more income, the higher class that you see, or the higher tier that you see better participation. And so I think the biggest shock more than anything is that almost 70% of the stock market, so ultimately 67% of the stock market wealth is owned by the top 10%, by the top 10% of those that are in that income tier. Let's keep rolling, y'all.